Here's the problem. With all the economic and political uncertainty in the world today, how can we be sure that our money is safe with the companies that guarantee our retirement insurance contracts? How can we be sure that these companies are financially stable and capable of fulfilling their contractual obligations, especially over 20 or 30 years of retirement? Well, to begin with, it is important to understand that a retirement insurance contract is guaranteed by a legal reserve life insurance company, which is regulated by both state and federal government, and that life insurance companies are among the largest and most stable financial institutions in the world, more carefully managed and more conservatively invested than other financial institutions, like banks and investment firms. In fact, life insurance companies are more reliable and dependable at saving, growing, and protecting your money because of two very important distinctions. One, unlike banks and investment firms, life insurance companies are legally required to maintain capital reserves equal to all of their contractual obligations. And two, unlike banks and investment firms, life insurance companies are legally prohibited from leveraging their assets. This means that insurance companies must always keep sufficient liquid assets to pay out all of their contractual obligations, and that they cannot borrow money to lend out to investors or to speculate in derivatives, which is why taxpayers had to bail out some of the banks and investment companies. Remember to keep in mind that the purpose of insurance is to provide guarantees and protection against the risk of loss, while the purpose of investment is to accept the risk of loss in exchange for a possible gain, and that your retirement insurance contract enables the insurance company to assume and manage the investment risk for you. So what do life insurance companies do with your money to save, grow, and protect it from risk? Well, they primarily invest in assets that produce income, like commercial real estate and corporate bonds, assets that generate predictable and conservative income from property leases and interest payments. So our money is combined with other people's money, along with the general assets of the insurance company, to purchase office buildings, industrial parks, and shopping malls, or to fund the development of major construction projects that can generate income from long-term leases with commercial tenants. This money is also used to purchase corporate bonds, which are essentially long-term secured loans to major corporations who pay interest on those loans every quarter to finance their acquisitions or expansion projects. It is also important to understand that a retirement insurance contract is a lifetime contract, meant to be kept for as long as we live, and not to be opened and closed like a bank account, or bought and sold like an investment. So if you terminate or cash out your contract, you could pay a penalty, known as a surrender charge. But a surrender charge is actually necessary and beneficial to everyone because it protects the integrity of the investment portfolio from potential losses caused by unscheduled liquidity demands, which enables the insurance company to optimize the performance of your contractual provisions. So ask yourself this: knowing that the companies that guarantee your retirement insurance contract must maintain capital reserves equal to their contractual obligations and cannot borrow money to leverage their assets like banks and investment firms continue to do, is there any safer, more secure way to protect your money and guarantee your income for as long as you live?